All right, we begin then with our question and answer session. We have received some questions in the past few days. Thank you for that. Questions that are coming in as we speak. And this is question number one. An investor, a stakeholder wants to know about the process. A company that you've invested in for a long time but has had disappointing results, especially if you compare it with peers, Tullow Oil specifically. What happened? What was the analytical complication, or was it a mistake? And why that weight in oil and gas in the portfolio? Could that be explained, please? That is the question. The answer. I will ask this friend, this stakeholder, to allow me to explain that list prices do not necessarily reflect reality. Sometimes a plummeting list price reflects a company that is doing terribly, but that's not necessarily the case. And we should think about two specific cases I'm thinking of right now. One is Consol Energy, which I think you know. This is a company that from $30 went to $3 in 1.5 years. Now, if you lose 90% value, obviously something happened. And our answer at that point was no, nothing's happened at all. Now, that's a difficult bite to swallow. No, nothing happened. You look like you have egg on your face. We really did think nothing had happened. And 1 year after, the company has gone from 3 to 30. So you divide by 10 and then you multiply by 10 in a 2-year period. Something similar happened with New Gold from 5 to 05 and then from 05 to 2, I think it was. So the first part of the answer is the list price does not really reflect. And in the case of Tullow, well, some things happened. We think not too relevant. Well, there were communication issues, perception, communication, management, perception, the investors, and then COVID struck, and we saw what happened to the price of oil, the 170 pennies to 7. Now, I also remember Murphy, right? Remember? We invested in 2005. I think it was $12 down to 1, and then from 1 it leaped to 30. So in the case of Tullow, we think that this is actually very similar to these cases. New Gold, Smurfit, it's cyclical. It is cyclical. You need to be patient. The assets are very good. This is very important. One of the most important assets. We're talking here about Western Africa. We're talking about oil. We need to be patient. So we're not nervous. Now, we see it's times 10, but that, I think, speaks of being on the right path. But we were talking about the process. I want to talk a little bit about the process. Our process encompasses many things. I mean, we study people, the incentives, the assets, the costs, the accounting strategy. So it is very intense. Of course, mistakes can be made. We're only human. And sometimes, yes, well, to err is human. But mistakes, that's always the competition for the most part. And in the case of Tullow or raw material in general, the competition, you know where the competition is, and you know what the competition is producing, and you know what you are interested in, which is, of course, the cost. So a competitive analysis of a company of this nature is actually much more straightforward than that of an internet company, for instance. I think that you don't have some guy in Silicon Valley pumping oil at $25, but that can happen if you're talking about an app to deliver food at home. So I don't know. I don't think it's anything that has to do with a process. Yes, there are some circumstances that are difficult to put up with, but what we think is that value is, in fact, being preserved, and I think that there is a positive future with regards to Tullow. Another question, what about the hikes in the fund over the past few months, especially so far this year? How would you explain that? That's the question. Well, my answer would be, these hikes. Why? Well, because we think the market at the end of the day acknowledges the value of our companies. We've always said that if we are right in our assessment, sooner or later, the short-term market might be inefficient, but long-term, the price will converge towards value. I understand that this response is maybe a little bit flimsy. Maybe you were expecting something deeper, such as this, that, the other, long words. But I think that this is the right answer, frankly. And at the end of the day, the underlying question is, again, an attempt to simplify our investment approach. Maybe I'm going to use, I don't know, the example I'm going to go for, I think, is very telling. It is from some time ago, it is something that did make money. So Freeport, for instance, a company such as Freeport had dropped from 20, a strong fall, and actually from 20 down to 5, and we were buying really, really cheap. So what happens? What happens? Or what does our process actually imply? Well, initially, an in-depth assessment of the sector, which is the copper mining sector. That's very ambitious. We need to understand what the drivers are, what the supply and demand, the structure of the industry itself. Is it concentrated? Who are the main peers? The cost curve. Why is that the cost curve? How capital intensive is it? What about regulation? How about alternative products? So it's a very, very detailed assessment, and I've just summarized it. And then you have to really study the company in great depth. Its mines, its assets, its origins, its background, management, the culture, the strategy. How are decisions taken regarding capital allocation, and so on. So $5 per share, well, what we do is we run the numbers. What does this price actually represent for Freeport? What is being discounted? What prices, say long-term copper, are implicit in this list price? And you need to know how to crunch those numbers. And then we run another calculation. So long-term copper prices imply what? So what are we talking about globally in the coming 10 years in terms of copper? And what is actually implied with regards to the demand? What about copper needs? Who demands copper? And what are the processes? Are we talking about industrialization the world over, especially in emerging countries? Are we talking about electrification, which we're contemplating for transition purposes? So we run those calculations, and we need to be very sophisticated. So $5 per share is obviously an interesting opportunity. But then you need to do more, because yes, you see the numbers, and a lot of people take the trouble to run the numbers, and they do so. But then you need to do more. Then you need to have the wherewithal, as it were. There are many who could, but not that many who actually get out there and buy. Maybe they don't dare buy because the price is falling, or maybe they're not sure how long it's going to take that mine to bounce back, because not everybody has that backing, say, if it's a professional investor, maybe they don't have the backing from the stakeholders. So there's a number of very important steps that have to be taken into account from the point of view of the process, as well as from the point of view of the philosophy, which stakeholders have to agree with. So Freeport goes from 5 to 30, or more even. Copper recovers from 4,000 to 7, 8, then 10, and at $30 we sold it all. So I could summarize by saying what happened in Freeport. Well, copper prices increased, but that really doesn't do justice to our process. I'm sorry, again, I'm repeating myself, but we do not respond like that. What happened to Freeport? Copper prices grew. No, we would say that Freeport at $5 was a market mistake. It was an error. The market had miscalculated. Why did the funds do what they do? Well, because it was an error. It was a mistake. The market was not faithfully mirroring Freeport's value. And in fact, well, this is what happens when we see the market reacting. I would like to add a couple of thoughts because, in fact, over these past 2 months, a very important element is that of coal. I agree with everything Fernando has said. I think he's absolutely right. But there have been some narratives, very specific ones, that were absolutely off the mark, and we have taken advantage of that. They were weak narratives, and companies were being chastised. One was the end of coal. Do we believe that coal is going to come to an end? Yes, coal is going to finish. But please, could we see slide 20? Please, 20. We've prepared it, and in order for coal to end, I was struck. Last year, Warren Buffett said that the last Mid-American coal plant would close in 2040. The problem is transmission, and we studied that, the infrastructures, right? So we see that we've multiplied by 2 in the past 40 years, and now what we want to do is multiply by 5 in 30 years, and this is absolutely impossible. So this narrative was off the mark. And as soon as the market understands that it's off the mark, well, we see how Consol multiplies by 10. But there's more to it. The coal thing has been so huge that people were confusing thermal coal, which will disappear in 15, 20 years, with metallurgic coal, which is what is used in furnaces to produce steel. So what? That steel was going to disappear too? Now, if you've spent a lot of money in a furnace, it's a zero possibility. The world grows. The world needs steel. Now, a company such as Arch, which we bought at about $50, as soon as the price goes up, this is net coal, metallurgical coal, and the company goes from 50 to 140 in 4 months. But at 140, it's times 2. So understand that this increase is exactly what Fernando's explaining. There's been a couple of cases where this is actually just the beginning. They've come to understand that the residual value which we need to have in Arch is not times 2, it's times 7, 8, or 10, but not times 2. So this infravaluation has resulted in a renormalization. So when Facebook was at a times 30, but it was at times 3, they make a lot more money, and then everything goes back to normal. The share price is times 7, and something similar happened here. And there's been others. People are going to stop going to the movies because of COVID. False. Look at Kinepolis, times 2 in 8 months, in 9 months. People don't stop going to the movies. Or maybe, people will never smoke. Well, British American tobacco has skyrocketed. So I think that a number of narratives that were wrong have happened. And what we've seen is, we've gone a little bit quickly to conclude so very quickly. So this has to do with technology. People are looking for other things. And we, of course, what we're doing is we're explaining this, but I did want to share this with you. And I also wanted to share with you slide 44, something which Fernando has explained, is that if you buy Freeport at 5, you're buying really cheap. This is the key to what we do. What you see here is by deciles, the companies, whether they are expensive or cheap, at takeoff. So when you see that line 1, it's a price-earnings ratio of 27, so the returns are very low. And when your PER is very low, you see it at the bottom, 11, it's 17.3. So you're times 2ing your money every 4 or 5 years. This is the key. This is the essence. Buy cheap. And that way, you will survive. Suddenly, it grows a lot in 2 months. Yes, more than we thought. But I think that those 2 or 3 narratives are very important. Very specific ones, which I believe are going to be changing the paradigm. I'm sorry I got carried away. This is fascinating. That's fine, no problem. We have many more questions about coal and energy and so on. This same investor has the same question. It is reference. Do you think that after this vertical growth, do you think that you need to leave the fund? My answer is, in the face of this strong increase, we'd have to sell. And that's what we've done. There's that percentage which is more than what we've had. And if it continues to grow, well, we'll continue to sell. Remember back in 16, I think it was in 16, April, between January and April, it grew by 55, and we had 25% cash. So that's what we'll do again if it happens again. And now we're beginning to rotate the portfolio. Please, can we see slide 46? Slide 46, thank you. Now, we can't be more explicit, unfortunately, but at this point in time, this is the pipeline of companies we are seriously contemplating. Look at this. This is home delivery, minus 67, e-commerce, minus 69, a sector, rather a financial sector, IA company that's dropped by 75%. Software, half. Real estate, minus 66. Two pharma, one down by 54, the other down by 79. Very interesting B2B in medicine that's fallen by 44. Biotech, which has more cash than what it's actually worth on the stock market. These are not just numbers. I mean, we're talking about many hours. Not one of them is part of our portfolio yet, so we're not naming names. But these companies have no debt. They have fallen, but no debt. That it's been absorbed by the shareholders. And this explains why these companies are not going to go under. In theory, it's actually very interesting to go shopping for things that have fallen now. So I just want to share with you that these are fascinating times. And I don't think that we need to divest of everything, sell everything off now. No. I like to think that it's, when we go into a wonderful gourmet store, the best oil, the best wine, and we bought really cheap. So, we bought the world's most wonderful wine for 15 euros. Wonderful. And that's Cameco, the best uranium mine. And why so cheap? Well, because they say nuclear is going to disappear and the Germans are closing their nuclear plants. But you look at the numbers, you look at how much energy costs, you see the safety, the guaranteed, and you say, this is never going to close globally. And then you see it's actually growing. So, you buy the world's best wine really cheap. Well, yes, this is a wonderful uranium mine. We don't complicate our lives. But, you say buying a little bit of ham, wonderful ham for a very little bit of money, I would do that every day. That's Arch. They're one of the best metallurgical coal manufacturers in the world. These are things that explain why we should focus on this. Having bought Canepolis and having left 1 year after, all we did was wait for 1 year. This is what we do day in, day out. And I think that, as Fernando explained, what happens is you need to work really hard, and most people find hard work very boring. So what we do is we go for the easy answers. We answer the easy questions. Sometimes we make mistakes. We try not to. 10-15% error margin, but you choose the easy questions and you wait for time to pass and you wait for, time prove you right. So I'm going on and on. Yes, I have to say that this stakeholder is absolutely right. Yes, but please understand what is going on.
Por aclararlo, creo que está claro, pero por si acaso que todavía se...
These are examples of rotation that still need to happen, most of them. In other words, when we explained earlier that the international fund, the value grew from 270 to 366, that's something that we have achieved before the value increase that we will get with this last step. So we saw companies. We didn't invest in some sectors. Fertilizer companies. Well, we've sold many and reinvested in other things. And this is what explains the value increase. And if we're able to do things well, and I think we will, as we have in the past, that we will be able to add to those 346. So sometimes we spend periods where we're not really able to create that much value, as in the Iberian fund, but that target value grows with the rotation that we're constantly working on, because that is the essence of what we do. Thank you, Manuel. And with that historical perspective that Alvaro talked about, can we say, I've been there, done that. It all seems so familiar with the bubble in dot-com bubble. Where do you think? What do you think you can compare this period to? Yes, there are a lot of coincidences to what we've seen in the past. In that period, 1999-2000, as well as now, we have seen the greatest valuation discrepancies in the past 40 years. Discrepancies, well, we have popular things that are listed very highly, very high price earnings ratio, whilst others rating very low. We have, I think, a slide where we can see this, in fact. I think it's slide number 45. This is in the US. This is the average share price of the cheapest companies compared to the market average. I think it illustrates things very well. And we can see how now, 2021, beginning of 2022, it is at very low levels, only comparable to those we saw at the beginning of the year 2000, which was the dot-com bubble. So a lot of value discrepancy, a market divided into castes. We all know what happened with the dot-com bubble. And of course, NASDAQ fell about 90%. Whilst the companies that we liked, some of them were called companies of the old economy. They were no dot-com companies, neither in their first or last name, were increasing whilst the rest of the market was falling. And that's what we're seeing, the market falling and our funds growing with strength. So that's the beginning of the correction of that huge discrepancy. I wanted to point to something as well. Can we see Annex 28, please? Because, yes, it is very similar to 98 in what you just described, but there's something where it's not that similar, because in 88 and 89, there were hundreds of companies that were very cheap, like Adolfo Dominguez at €5, Mapfre, Aldeasa. These were very good companies listed at a very low share price. Now there aren't that many. If we look at how expensive the market is, that's companies from the S&P that has 10 times sales. Now it's 14%. And if we can look at the next slide, slide number 29, just to compare both periods. In slide 29, we see the market cap over GDP, and in 2000, it was 1.75, I think it was, and look at it now. So there aren't too many cheap companies. There are some cheap companies, and those that seem cheap, there has been a very strong digital disruption. So some look cheap, but I'm not convinced they are cheap. And then another difference is that the system is a bit more fragile because of the huge amount of debt there is. There's a personal question too. Alvaro, who challenges you? Who can make you change your mind in terms of where you invest? Fernando, all the time. So we follow an investment process. We cannot include a company if it is vetoed by someone. And we discuss things, and I win and sometimes Fernando wins. Now we have Paul too in London, and we have a management committee meeting every Monday where we talk about the company. I don't think the veto has been exercised, not a single time, but perhaps two try to convince the other, and they do, and that's how we've done it. And also, there are other people in the team who are starting to make their contributions too, and they're putting, and for example, helping us with growth companies. Peter Hiding in London, for example. We have Javier Campos, and we have young people who perhaps cannot make us change our minds yet, but in the future, perhaps they will. So our investment process is to try to destroy an investment theory. Look at all those things that could destroy it. It's not a matter of one saying, I think that this is going to happen. Well, you need to convince him of the contrary. So it's a lot of people working on this. We like it. We challenge each other. Everyone says whatever they wish, and they are challenged. And so every Monday we have this committee meeting where we have an intellectual fight or friction. And it's interesting because that friction must exist and there must be no consequences if people disagree. If you disagree, it's better than if you say yes. Fernando, would you like to add something to that? No, I think you explained it very well. We talk to other managers outside of Azvalor. That's always very interesting. We talk to managers who have the opposite investment strategy. We want to understand why they invest on the short term with investments that are not similar to ours, but we always try to break our theory where there might be a leak to make it as sound as possible. We have a question now about return vis-a-vis the reference indexes. From the beginning until now, there's been a technical tie with the SMC Europe net return, but the SMC World has not been outperformed. Is there anything that can make us believe that we will be able to outperform these other indexes? I have taken some data from all those indexes, and Azvalor International, 84% return. The MCC Europe, 36.4, so 48 points better. The world one, it's not our index, 53%, 59. We did 59% one. The all countries world, which includes all Asian countries. We don't have investments in Asia, but just to try to answer Antonio's question, 82%, a little bit less than we did, and the S&P 500. They did very well. But I wanted to answer that because I looked up the data on these indexes. But what was the question? The question is if there's any possibility of improvement to beat or outperform these indexes at Azvalor. Well, the price, the PR, I think is a good way to answer the question. Our return is much better than many indexes. Perhaps I can show you an annex. Annex 38. You mentioned Standard & Poor's. This is a valuation of energy and metal companies. They're still an important part of the portfolio. And look at where we are compared to Standard & Poor's and to the average. So I dare say I think Standard & Poor's is expensive, very expensive, and ours has a potential of 80%. Mark asks, the ultra monetary expansive policy in most economies has made asset prices more expensive. International managers have decided to discount cash flows of companies at a whack of one digit. As Valor, do you think that this is the end of this? What minimum WACC do you demand in your investments? Congratulations for this fantastic year. The time puts everyone in its right place. Fernando, WACC. We should clarify what WACC is. The discount rate that you use to discount flows. Monetary policies have increased the price, I would say, of most assets. Not all of them. Fortunately, there are always cheap assets, and we have found them, and this is why they are in our portfolio. But it is true that the level in general has increased, and more specifically in a very important debt class of assets, which is fixed income, where levels have been reached that we had never seen in the past. Even in sovereign debt, we've seen negative nominal rates. We had never seen that before, and it sounds ridiculous, no? That they charge you to lend to the states. So in the academy, many people defend that in order to value assets, you need to use free risk assets, which is sovereign debt, and then based on that, value comparing it to the other assets. Equities would be worth more according to that. Or to give you an example, we could say that if we're talking about a European company and the German 10-year bond gives you 0%, discounting the flows at 3%, a discount rate of 3% could be appropriate. It would be like valuing it at a PER of 33. We don't think that makes sense. It doesn't make sense to use an overvalued asset as a reference to value any other asset. When this overvalued asset, fixed income, is not really the reflection of market price. So we don't do that. We're more conservative, and we use rates similar to historical rates. Historically, we've said often that the stock exchange is listed at 15 times profit. That's a discount rate of 15–16%. Sometimes we've said that for an investor, more than using sovereign debt as a reference, they should look at their real opportunity cost. What is their cost of opportunity of investing in the stock exchange? We use other rates. And I'm not going to say them here because we shouldn't be that transparent. Let me insist on one thing. Yes, we have been criticized that using our rates, we cannot or could not buy all the internet shares that were going up so much. But now, in the previous share, we saw the fall of some of these companies. Some of them fell 70%. In Azvalor, we cannot follow fads. We have a process that we've been using for 25 years. It does work, and we are going to continue to maintain our WACCs at that level. But if we find really cheap things without having to use a low WACC, let's say Amazon, I have no idea if it's expensive or cheap right now, but maybe you need to have profit estimates that are very high, think that the company is going to make much more money in the future, and perhaps some people do have that vision, and maybe they get it right. but you have to give it at a certain discount. If the discount rate is a bit high, if you bring those future profits now, it's not that cheap. So this is a fad, and I don't know how long it will last. As soon as there's a little bit of inflation, it isn't that easy. Fortunately, we didn't have to invest. No, we didn't have to find value at those discount rates, or we would have never invested. Using wacc, because of course coal deserves a higher wacc, we still got 3-4 times. That's an added security margin. That's part of the shelter concept. Another question. Considering that the goal of the fund is to get a return that is higher than inflation, in the international fund, what is the goal? The annualized return goal, it's two things. One is what the stock exchange does and how we can outperform, by how much do we outperform the equities market. Historically, 500, 600 basis points more. We have 11, I think it's, yes, since March 2003. Yes, 11 a year is not bad, but I think it will be higher because there's a part that we don't control. But can we see slide number 36, please? I don't know if there's going to be more inflation in the future or not, but that opinion should not really affect our investments. That's the actual annualized return in inflationary periods. And as it says in green, it's been 25% of the past 100 years. Energy and metal companies got 6-7% a year, and the Standard & Poor's, not. They didn't get returns. So I think we are going to get 600 basis points. But the international annualized return, if Standard & Poor's, as the strategist Jeremy Graham, who usually gets it right in his 10-year return predictions, long-term predictions, he's not very optimistic. So if it's -1, we cannot get 15. We can do 7, 8. Would you like to add something, Fernando? Well, that's very valid what you said, but that's not exactly how we do it. That's a reference, right? We always try to have the best portfolio that we're able to have in any point in time. After working very hard, if we didn't do as well as the indexes, then we need to ask ourselves what we did wrong. But more than a return goal, it's the performance. That's our obsession. How can we improve the portfolio? What is the best portfolio that we can have? Should we look at these companies? That is how we work. There's a question for Sergio, although anyone can answer it. Are you thinking about launching a new fund or investment vehicle? And another question from another investor, Jordi. Are you thinking about launching a hedge fund? Perhaps because it would give you more freedom in your investments. The asset class that we manage is equities with the Iberia International, the blue chips, all these funds. We have the 2 pension plans, the consolidation one that can invest 50% in equities. We have the Luxembourg SICAVs. So from the structure point of view, we have a very wide catalog. But our obsession is to have a product that would allow us to structure on the very long term, because the aim of the product is that it should adapt to the management we want, which is long term. The more we can structure a product to the long term, the easier it is to manage, and the higher the probability of getting high returns. So, if possible, in the future, we would not discard having a product that can be committed to the very long term. It would be interesting to look at, because a long term product is like a letter to Santa Claus for the management team. They're always looking for the alignment of the product, investors, and the management team to be as aligned as possible. It would be a letter to Santa Claus for the Peter Lynch Fund. Yes, if Peter Lynch would have structured a private equity at 15 years, he would have made a fortune. But he didn't, because he tried to do trading with a fund. Fine. Enrique is asking about the relationship with companies in general. How is the interaction and relationship with the management team of the companies in which you have invested for such a long time? Well, good, I would say. When nobody pays attention to companies, that's when we appear, and we are welcomed in the shareholding structure. And we establish usually a very productive dialogue with them. We do our homework. We do our homework before we meet with them so that they can answer our questions. Since we usually invest in companies where things are done properly, we vote in favor of the board in the AGMs. So we have a very good relation and a very productive dialogue with the company's management. As an anecdote, a few years ago, the former CEO of a Belgian company came to see us. And when I told him that in our investment team, well, he told us that he knew us very well because they had audited the company. So I know how you work because I've had you in my offices analyzing my company. And I saw how demanding you were when you audited my company to see whether you wanted to invest in it or not. Domingo is asking, good afternoon. If we have two good quality companies, one with a PR of 10 and growth of 10%, the other one with a PR of 20% and growth of 20%, which is most interesting to invest in? Well, it's oversimplifying the problem, but just to answer the question, I would say that the first one. Arithmetically, the second one would be a better investment, but on the very long run, if it keeps that growth premium over the second company. That's the difficult part. That's why I would prefer always the first one, because it's difficult, first of all, because there are very few companies that can achieve that in a competitive economy. Achieving those growth premiums, well, that's very difficult to do. Very few can do it. But it's even more difficult to identify it a priori and to get it right. There are some that for 2 or 3 years have a very high growth rate, and the share price is at very high multiples, but then they can't continue to grow at that same pace, and they disappoint you after a few years. And so the market expectations on their profits suffers, and so that's a mistake. So it's much more difficult. And that's, the paradox of the wealth investor. It's very fascinating. Everyone, or a lot of people, try to find the Apple or the Google of 10 years ago. So we need to take into account that these are exceptions. And that explains the fact that it is more difficult to find growth investor managers that have good returns on the very long term. I suspect that if I were to ask the people who are listening to this conference today, they will all know the name of a few wealth value managers, but growth managers, perhaps they don't know many. Why? Because it is much more difficult to do. I disagree of everything you just said. I know that some students are listening, and when you say Apple PER at 10, that's growing at 10%, or the other one, I don't know if there are barriers to entry in for one company and not for the other. So people who are listening should think that it isn't as easy as that. Do both managers share the company, always thinking about the shareholders? Is one more aggressive than the other in their management style? I don't think you can answer that question, frankly. I want growth, huge growth, and not pay too much for it. And if I 20 this year and 20 the following year and 20 the third year with a PER of 7, and we have done this, we bought Kindle at a PER of 5. Well, but the important thing was not PER or growth. It was that the shareholder was respected. So, first of all, you need to see whether they're stealing from you, because since 2010, stock options are a fad and other things, which means that the CEO and his team are a minority shareholder. And they take 7, 8, 10% of EBITDA. When I see that, when I look at that list that we saw, I always see whether the shareholder is number one for these companies or not. If I am not number one, when the market falls 50%, I don't dare buy more. I like to know that Jimmy Brew is behind Consol. Paul, Fernando, and I feel comfortable with that. If it is a company that is very interesting, but their shareholder gets 2% every 5 years of 2% stock options, well, I'm not interested. So it's not that easy. This is a message for young people. You need to look at the balance sheet, many other things, and then we can talk about the PER and which one grows more. But I can't answer the question that easily. I don't disagree that much, but I can answer the question.
Esto es sobre simplificar y me he dejado llevar por la pregunta, efectivamente.
Bueno, yo os dejo plantear una pregunta a vosotros dos porque tengo dos para Javier que ya tenía.
I have two for Javier. Maybe we can talk about a company, an example. These companies that we've talked about, which seem to be cheap but aren't really. So think about it, and then I have a couple of questions. So why did this fund perform so well in 21? Do we have hopes for future fantastic results? My answer is that yes. In 21, it's done very well, and in 22 also. Remember, 2020 was a very difficult year. There were losses. Yes, there has been a recovery, but if you see the profitability, it's about 10% per annum, which is less than what the managers have achieved in the 3 or 4 decades that they've been managing assets. So this style of a manager has had headwinds really over the past 10 years. And the slide that Fernando was showing, I think, was very telling. It's changed in the past 12, 16 months, but we are at the very beginning of the hall. And then with regards the path to be completed, well, we talked about rotation before. The managers of the fund, well, part of their daily activities is active management of the portfolios, rotate them, sell what's gone up, and always, of course, remembering what the reasons are. So that simplification, if you will, of, oh, it's gone up a lot, no more paths. I think that that is excessive simplification. I think we have to be much more focused, study the portfolio and see how it actually is performing and not take shortcuts and not give in to biases that lead to the wrong decision being taken. And in the introduction, I said, if you remember, that when we look at the ratios, it's not only price benefits, it's if you see book value, if you see free cash flow, those are very low levels, which we really hadn't seen since the beginning of 2020, the beginning of the life of the fund. And then another piece of information, if we study the companies that now make up the portfolio, on average, they've dropped by 47% from their highest point over the past 10 years. So what this means is that these companies have already suffered. Their list price, at least, has already overcome a storm, if you will. And logically enough, what we do is we analyze that the numbers have been well calculated, and they see that the discount at which they're listed is very high, and that gives them leeway. It allows them to think that the portfolio will continue to perform forward-looking. You talked about rotation, and Isabel also talks about rotation of managers, and she asks what factors would lead perhaps to substituting one of the managers for another one. My answer is that this is a great question, and there's a multiplicity of factors. We could talk about this at very great length, but maybe the two main reasons which happen, which take place, is first the change in a team. This is a problem which we definitely try to mitigate. We work with managers who have a specific type of a boutique. They're owners of the company who invest their capital. They have the right ecosystem as far as we're concerned, in a nutshell. But it is true that this is an ongoing problem in our sector. And, well, I have to say that it's actually a headache for investors. Yeah. So it is a problem. Yes, it is. And furthermore, I would add that if it happens with a certain degree of frequency, that change in the managing team, normally this is a telltale sign of other deeper problems that will perhaps affect performance. When there's a change in your team, it's problematic because you have to analyze what's happened. You know, having an analyst leave is not the same as having the head leaving. You have to study how that change is going to impact the way you do things in the investment process proper. So yeah, you need to study the manager, study the fund, and start from scratch. And this, of course, implies a lot of work. It implies really not taking your eye off that ball. And maybe something else which is important also is that you need to have not that many assets under management. In other words, grow, but not grow that much that you need to do things differently. So you can't have, say, a manager not being able to invest as she did before because they've grown too much, right, in terms of volume of assets managed by the firm. I mean, we've talked about this with our managers at great length, and we are convinced that they are very focused on this, and definitely this is something that we do monitor in the case of each one of our managers. We want to ensure that everything is shipshape, as they say. And, well, at the end of the day, what investors do in this fund is they delegate in us, this monitoring, other aspects too, things that have to do with the investment process, more technical details, which are a little bit more complicated to explain. But we need to make sure that everything is as it should be. Thank you. We never talk about companies that are not in the portfolio, but this stakeholder would like to know whether there's a value club, a company that might seem to be cheap, but when in your eyes is not. Well, we can say, but generically, because sometimes we've given names and we have received phone calls. So what company might seem to be cheap, but isn't? Well, the people who lie with their accounting books. And then there's other companies that would seem to be very expensive, but actually aren't. So how can they hoodwink you? Well, not in 1,000 ways, but yeah, 8 or 10 ways. And you need to know those 8 or 10 ways. And sometimes it's not very forthcoming. We're looking at a company right now which has dropped by 70%. And every year they have an incredible amount of exceptional expenses. 10 years And you're saying that every year they have 1 million. I mean, the company is worth 10. So, maybe that's not so exceptional. And are those exceptional expenses linked to something which is perhaps a little bit impressive? Well, it might seem to be cheap. It might seem, it's very cheap. It's a single digit. And we're there. We're not sure. I'm not going to say anything, though. I'm not going to give any name. No. In these very uncertain times when the visibility of future plans is perhaps not that great, so the future cash generation of any given business is less obvious, how do you determine the right price? What are your models? Well, models, the right price for a company, it's not a model that churns that out. No. First, before you look at the models, you need to understand the business. In other words, is it capital intensive? Is it easy to copy? Is it intensive in terms of manpower? What's the competition like? You need to know, and this is not easy, who is really in control and what does that person want, and are the means available? Are the means available? If the ends are right, we, as long-term investors, good. And what are the means? Again, I repeat. So this first part, you haven't even looked at the numbers, but this is time-consuming. It's a lot of work, and it's easy to be hoodwinked. Secondly, once you've done with the first portion, I think what Fernando and I do is we wonder whether what we see in the rearview mirror will allow us to look into the future, because if there's a huge change in paradigm, that's very difficult to actually swallow. And then this is very complicated. We're looking at companies now, we're thinking of rotating, and some of these companies are very interesting. Some are very well-known companies, and they have these PERS which have been up and running for 20 years. Just this morning, I was talking with Paulie, and he said the rotation is what it is. Yes, but iron ore or coal is has been alive for a long time. So you know what you can expect. You know that you can foresee possible events. I think that that's very important. And then when all of that is clearly understood, then you can actually study the company and say, this is how much it's worth. And if you understand the business, and if you think the future may well be very similar to the past, well, is it more gourmet? Is it less gourmet? What is the setting? What is the macro? How much of a debt level? But not really wander too far from there. But I would like to, and I'd like everyone to understand that there is no silver bullet. There is no guru. When Peter Lynch stopped working 14 hours a day, he said, well, if I don't work 70, 80, 100 hours a week, it's really very difficult to achieve anything, especially now there's, more people. 25 years ago, there were many companies and you were the only one to really get to know them. But now, that's not the same. There's always somebody who's from the States and who's looked at an Italian small cap. I don't know. It's very difficult. I said before, we need to only take the easy questions, because the really smart people get burnt easily. I remember back in '98, Buffet said it was impossible to get 15 people with more of an IQ than Merriweather, and they went broke. They swam with sharks. Well, guess what? Don't swim with sharks. Swim with goldfish. Just take the easy questions. And something a little bit more personal about investors. What are the traits of an investor who will be happy to work with you? My answer is that, well, I think that the happiest customers are those who made money and forgot us, Customers who began to work with us back in 2003, I think has multiplied their funds by 12 over 18 years. And those clients are people who trust us. You'd have to ask them why they trust us, but I know that the ones I speak with are friends now at this point. These clients are friends. Well, there's three things. First, they know that this is difficult. They know that this is time-consuming, and they know that simplifying is very difficult, very, very difficult. So they delegate. Something which is very important is that they don't think that they can outsmart you, because they know that this is all about time and they just don't have that time. Another specific trait is that they trust the process, I think, because they've seen the results. So when you see things are dropping and you're scared, but then you see that they bounce back for so many years, I think that that definitely encourages trust. And as we saw in the initial slide, every 2 or 3 years, you have something untoward happening. Well, they don't buckle under, but you'd have to ask them why they trust us. I think that would be a good thing, because maybe there's other reasons. No, I think that you've enumerated them all. I would say that at the end of the day, these are persons who have to be very similar to us, actually, because that is how you align. You know, we say value investors. Yes, these are value investors indeed. We have investors, for instance, who sometimes, I remember after Lehman Brothers, for instance, at the end of 2008, beginning of 2009, when everybody was fleeing, we thought this is a fantastic opportunity. You know, let's see whether we can actually go shopping, because these are incredibly cheap prices. Despite the tragedy, of course, COVID, the same. We knew that these were historically low prices. We knew that this was an opportunity, a true opportunity, and others also, identified this. So to talk about a specific trait, having a contrarian, I think that's the case. I don't know that there are investors who say, shouldn't we be selling now? In general, our clients are value driven. What we saw in 2007, 2009, I think that our clients know that the team is very good. Beltran achieved something incredible back in 2011. So it's important for us to try to emulate him back in 2011 when Spain was bailed out. But COVID times, we've had practically no one departing. So I think that, yeah, we should be proud of our track record. I am proud of our shareholders. And if this were not the case, I don't think we'd be here today, because, in fact, if they sell at a minimum, this would not be possible. This business would not be possible. I know that we have to say congratulations, because most of the stakeholders, most of our clients are in it for the long run, as they say. Well, thank you. Thank you for that. Congratulations. Now, a question. In a world in which there's more information, but in which it is increasingly difficult to understand the reality of things, what are your sources of information? My answer would be that there are very many sources of information. Our sources are, again, back to the process, very Cartesian, perhaps boring, but we differentiate. Paul, Fernando, and I, we differentiate between primary sources and value-added sources. Primary sources are sectorial magazines, official economic data, reports published by companies, so cold data. And then you have value-added sources, which are perhaps a little bit more subtle. So those conversations that you have with former employees, conversations with experts, meeting up with different entrepreneurs, knowing who the entrepreneurs are. And those are the sources, but the sources don't get you anywhere. You need to have the theory that liaises the data and the source with whatever it is that's happening. Causality, as I say, why do things happen? Sometimes it's impossible to understand, and you need to know that you're not going to understand it until you do the right research. We have people on our team who are very keen, who say, oh, I want to be a manager and I'd like to be a manager tomorrow, which is good. It's good to be hungry. It's good to be ambitious. But it's many, many different things that need to be taken into account. You need to know about history. You need to understand how the economy actually is run. You need to know a little bit about game theory and psychology. You need to identify a simple from a complex system in order to understand the interactions and the things that happen. So those are sources as far as I'm concerned. It sounds like a lot. Maybe it is a lot, but you have wonderful investments being carried out by 20-year-olds. We were doing that. I insist what you want to do is choose the easy questions. Answer only the easy questions and be very patient. I'm not really answering. Maybe Fernando wants to add a little bit of information. Yes, about sources, what we try to do is siege the company. We attack on all sides. I knew he was going to say it much more suavely than I was able to say it. No, you've explained many things which are very important, but at the end of the day, what we want to do is ensure that we all advance in the same direction. Different visions, no doubts, no queries. It's very important. It's what the company publishes. You have that information. We try also, of course, to look out for that manager who was in the company a couple of years ago. Look him up on LinkedIn and ask him to give us his interpretation. Anything and everything that will allow us to achieve what we love to achieve, which is to really get to know the company. It's very difficult if it's a huge company, but between 5 and 10%, yeah, we can get to know that. And do you think that there's a pattern? I mean, sometimes, it's not like we're looking for companies. It's the companies who come looking for us. So there's this acknowledgement pattern. Say you have a macro issue in a given country. Well, you're there and you know that there are specific types of company that you can look at, that you can think of buying. Are those sources? Yes, they are sources, because it's life's experience that teaches you and tells you there's buzz in stainless steel. So you know about nickel, you know who's good, you know who's bad. It takes you a while. I remember we bought a company for a blue chip company. It was a new company. Paul knew the company. The company had had a scandal and it had plummeted. So we recognized the pattern and we went in. And that is where you have less of a risk, actually, because there was a lot of pessimism in that list price. A piggyback question about the London office. Sergio talked about his London office. Is it a subsidiary? Could you please explain? Are you thinking of growing? And Ruben also has a question about London. I've heard that you're going to be growing London with 3 analysts. Well, the London office is a UK establishment in technical terms. It is somewhere between a branch and representation. It's a rep office. We changed our venue a couple of months back. We have 3 people there now. And as we said in our presentation, the Madrid analysts are traveling a couple of weeks every quarter to London. We believe it's essential to have a presence in London because you have access to direct information there. And we definitely are considering the possibility of growing. London is a very difficult city, very competitive. It's difficult to hire really good people. There's a lot of competition, but we're definitely thinking about that because we know that we should be there because it's going to allow us to achieve a better degree of analysis. And as to the project, that second question, could you repeat the second question, please? Yes, you said that you would enlarge the London office, you would take on 3 analysts. Let me answer by saying, as Sergio said, research happens in London. Our people go to London. Michael is there, and we're constantly interviewing. What we don't want to do is publicize who the analysts are until they've been there for a long while, because as we've explained often, analysts, what they need to do is crunch the numbers, do their accounting, and that takes 2 or 3 years, and then either they become part of the management team pretty well, or they get bored and they rotate. I began to work back in '93, and there was a rule which said up or out. So it is a very similar ecosystem, what we have in place. At the end of the day, there's analysts who are always needed, but what they do is not difficult, but it's got to be done, and there's not that many people who want to do it. And as they do their job, they progress. The investment decisions are taken by Fernando, Paul, and myself at this point in time. And what the analysts do is they analyze. I think that right now we have Patricia, Alberto, Arno, Peter, Michael, Paul, Fernando, and myself. So there's 8 of us, I think. Javier, yes, of course. And I think that I mean, Javier's interviewing people as we speak. So this is an ongoing process for sure. A long question. Good afternoon. Congratulations to the team for results obtained so far to date. This week is an important week. I believe that results are satisfactory. It's been very difficult, but thanks to my decision to contribute more money, the results have been good. I hope that this continues to be the case to the future. My question is, after the recent events, because of the increasing prices in raw materials, have you rotated the portfolio? What would you say? Let me answer by saying thank you for being so loyal. And rotation happens constantly. We've said that before. We sold copper with triple digit in First Quantum and then Freeport because some companies were some fertilizing companies were more affordable. We sold them, and we saw what happened. And over a year and a half, we thought that met coal was cheaper. Then we sold Cameco and the physical uranium holdings. The holdings grew by 70%, and now we're leaving after that. Now, this sounds very easy, but there's a lot of victims left on the side of the road. We've sold, we've bought, logically, and what can I say? I wanted to just explain that we would like for this idea to come through very clearly. Rotation is what allows us to maintain a high revaluation potential in the long term. Another question. This might sound disruptive in such an excellent year, but are you thinking about reducing fees? I can take this if you want. I will have to refer to what I said last year. The situation was very difficult. There was a difference between active and passive management, the difference between boutiques and general, but especially what I was talking about back then, and I think it has made sense over time, is that fees are a variable of the profits of the funds. So over the past 2 years or 18 months, it would seem that we were right. Fees are not expensive or cheap. It is the proportion or a variable of the profitability achieved. We are ambitious and we charge the market average. Well, we don't think that that's unreasonable. I would actually say something, Beltran. You're right in what you're saying, but it's true also that there may be some who will say, yes, but other people are really profitable and they charge less fees. But those people don't think about closing the funds. I'm thinking about an American manager who talked about that. So he wants to manage 15 billion. Now, this is a club. We reached an agreement years ago, and we said we're not going to exceed 2.5, and that maybe you're going to achieve that number never in your life or before 2 months are up. So you have 4 tickets for the end, the final game of the Champions League, and that's what we think we are. And you're not going to sell them. You're going to keep them, and then there's no more tickets. You're done. Another variable, apart from the fact that, of course, what is expensive is expensive, but that's another concept. In order to achieve that 15%, you have to close, because otherwise you'll never achieve it. So, great. Another question. We see the revaluation of the international fund. Is now the time, or will managers look at other assets when they think the time is right? Okay. I would say I recommend not. I recommend that does not happen. The potential is of practically 100%, thanks to the rotation that we have implemented and which we, in fact, carry out. And this is thanks to the increase by 35% of the fund's value, 35, but also because we are focused on that rotation. We know that some of the products have borne fruit, and we are constantly investing and renewing that potential. That's what we do for your good selves. And I've explained often that when we talked about Magellan and Peter Lindsay, the decisions taken by investors are not necessarily good. They can, of course, do as they will, but I don't recommend it. I think it's very important that we insist on the fact that, rotation is not something we do because we want to explain it. No, it's, something which is ingrained in us. Please remember that we believe that it's obvious if we are, just an example. Let's see. If I'm getting a dime for a nickel, we like that. But then when we can sell that nickel for another nickel, well, maybe we'll have to do that. We think it makes sense, and we would do it every day, morning, noon, and night. So from that foolish example to executing, it has to do with being convinced. In other words, we are seeing a dime which is listed at a nickel, and that's what we're focusing on, conviction. And we believe that we're doing the right thing. So this is obvious, and as I say, it's ingrained.
Can you explain it in terms of plantations? We've already harvested Cameco and others. We've invested in Blue Log. The plant isn't, is growing, but not fully grown. We just seed Susano, and then we're about to do to invest in other very attractive firms as well. So the future return will be the result of how fast we harvest, how well we seed, and it's a process we've been following for 25 years. And we learn with our mistakes, so we improve every day. And this rotation, as I said, is what allows the funds to keep long-term value potential. Two more questions about rotation, and see if you want to answer them. It looks like commodities will continue to be a source of value because you have exited from some of them because they reached their target price. Are you going to buy again in commodities? And the second question, where are you finding opportunities for your future investments? Well, we don't do it by commodities, but company by company. If copper were to fall, we'd look into it. But the few companies in copper that comply with everything we ask for perhaps are not attractive, or they fall 50%, and so we suddenly invest. So it's, price and value. That's the important thing. And in terms of future investments, we've seen some cutbacks, not only in the ones we've mentioned, others too. There is one of our historical companies that, is falling. And among those plants, there are future, there's a lot of future in many of them. Are you thinking about investing in assets that are more undervalued? Well, that's a very interesting question. Can we see slide number 30, please? Oil. Eloy is the person asking. Well, Eloy, there we have the bullish trends. We have the blue line, dark blue, from 74 to 81, multiplied by 7. The second one multiplied by 7 to the clearest line, the light line, by 4, multiplied by 4, and the round circle multiplied by 2. That's the probability of the class. Perhaps the case is different. We don't have to oversimplify, but it looks quite good because we still have a significant part of our portfolio invested in companies related to oil and gas, but things are changing. In some companies, we've multiplied by 2.5. We've reduced a lot. And in another one, we still have investments. Others, we sold our stake, a Canadian company, for example. In others, a few days ago, from the oil gas sector, we are buying in some and selling others. So the rotation, although we're invested in energy, is different because some companies are at minimum levels, and whilst others we multiplied by 3. So the composition of that part of the energy portfolio has changed a lot. And the last question with regards to commodities, Camilo says, it looks like commodities have begun an escalation that was already announced because of the disappearance of producers as a consequence of COVID, and now aggravated by the Ukraine. The valuation of the international fund is made up by daily share prices. But is it done by prices lower or higher than the rally? Good question, and I know who's asking. Camilo, very good question. Very, very good question. Well, it depends. Fertilizers, the valuations are lower prices than the ones that phosphate and potassium has reached. And shares, and the shares that went up above our target price, we've sold. Oil at 75 and not 120 as it is listed today. And as Fernando said earlier, although companies have gone up, the situation is different if instead of simplifying, we look at the granularity. Producers have increased very nicely, and we've sold a lot of our stakes in these companies. Services have not gone up, and we're buying, like Técnicas Reunidas. Dealers have not yet seen the leasing rates of their equipment reach a certain level. It hasn't gone up compared to what's left. So we're covered, I think. I think we are covered. And if oil were to be corrected, well, it has already from 180 to 90, we wouldn't alter the target price. Have I left something out? Well, copper. Well, copper we have very little now. Just as a thought, a year and a half or 2 years ago, all these companies were valued at prices above market price. Yes, we've increased the target price of the copper from 750 to 830, but we have very little copper in our portfolio. It's at 10,000 now. So what Fernando was explaining, it's like Vega Sicilia wine. But when the fertilizer, potassium, everything goes up, then it becomes too complicated. And so when it gets too complicated and there are sharks around, we turn around and leave. And we look for somewhere else where there are seals and not sharks to swim with. Camilo, the second part of the question. Commodities, they are their own worst enemy when they reach a certain level. So how do we protect from that? Camilo is very smart. The cure for high prices is high prices. The cure for low prices is low prices, as the English say. That's why we leave. Sometimes we will leave sooner. But optimizing, when you optimize, you make it more fragile in investment and in life. You want to do 40 things at the same time, you don't do any of them right. We want to have a robust portfolio that can withstand anything. A question for Javier, and the next one for Jose Maria. And this question for Javier and for the managers fund. What does a manager Azvalor, what does it contribute compared to the international Azvalor fund? These are different funds. In Azvalor Managers, we have a good choice of managers around the world. It is where investors don't have to be worried about monitoring their investments in a given fund. And they have access through Azvalor Managers to managers that otherwise would not be accessible in the European market. And answering the question, if you look at the Azvalor Managers and Azvalor International portfolios, the overlapping of these two portfolios is about 5 to 6%. They're quite different. They complement each other. Though the link of the four managers that we have right now in the managers fund as well as in the international fund is to buy things below what they're worth for prices that are very much below the value of the companies. But then in the investment process, each one uses their own analysis methodologies, and they are quite different. And that is why the result of the final portfolio is also quite very different. Just to give you an example, it's like a fishing boat with a skipper and the way he likes to do things, and others that fish in different waters with different styles. So, personally, I have investments in both because I think they're both very good. Fernando, would you like to add something from the international perspective? I would add something. When we pick the easy questions of the exam, we're very limited. And things that we cannot do. Businesses with a local component, we're not going to invest in that. In Japan, perhaps we might do something, but it's a bit difficult. So if you find a Japanese company that does real estate in the Philippines or in Iraq, that sort of thing we don't know much about and we don't know how to do. Jose Maria, question for you. Is Azvalor doing something for people suffering from the conflict in Ukraine? Are you helping them? Well, thank you. This is the first time that I get a question in this conference, which means that things are going very well. This means that you're very intelligent and generous investors. So I'm glad that you have a question for me. I hope you will have questions for me in future conferences as well. The conflict in the Ukraine has started less than a month ago. Well, it started earlier than that, but the invasion started less than a month ago. And Africa Directo, we work in Africa, have been working there for many years. We work with refugees whose situation is even more difficult than those of the Ukrainian families. Their Ukrainian families are going through many difficulties, but African refugees, nobody welcomes them into their homes. Nobody helps them find a job. It's even more difficult for them. And those are the refugees we work with. And we work as, as the philosophy as Valor. People who really dedicate their life to that, and it's very difficult to find the people who do that in Ukraine. For example, just as a joke, imagine an association that translates into a very local language the traffic signs. And, well, those things happen in emergencies. I've seen it in tsunamis, in many crises. So, as Alvaro said, we need to swim with seals, not with sharks, and do what you know how to do and with people who are doing a good job. Although we cannot work in Ukraine, I have I'm working with Caritas to help because Caritas has the possibility of working here in Spain with the refugees that come here. Many of them don't come here because they stay in Poland. Very few get to come to Spain, those who have relatives living here or friends here. But I am helping out, picking up the phone and knowing what others are doing and whether we can help or not, to see what other organizations are doing in Poland and Moldavia and Romania or whatever. Picking people who are there already, who have been there for some time and know what they're doing, and see if we can help them. And I also got in touch with the association in Madrid responsible for a center where for Ukrainian families, they have 500 rooms for them, and 20% of those rooms are occupied already. And when I offered to work as a volunteer with them because they are in Pozuelo, and I live in that area, I said, what can I do? And one of the things they told me was, and it's logical, they said some of the families who came brought their pets with them, and we don't know what to do with their pets because they cannot stay in a public center like this one. I think it shows their good heart because they want to do something. The child who has had to leave his father fighting in the war and leave their school, his friends, at least he has his pet. And we're seeing if we can keep some of those pets. We've gotten in touch with an Airbnb for pets to see if they can take care of a few of these pets. So what Azvalor has been doing for some time in Africa, the Africans who escaped from the war don't even think about taking their pets with them. And there are many more things. I looked at a web page to see whether I could support a family. Maybe you can help them, for example, taking care of their pets. There are many things that we can do. I'm trying to find out what I can do. But of course, each one must do what he knows best. And now in Africa, I'm sure less aid will get there. So I will continue to work for Africa. Thank you. We have a question. For a long time, you've been talking about uranium, and the European Parliament defined it as green, unthinkable 4 years ago. And you also talk about inflation. And now it's obvious that you predicted inflation so well. Do you have a crystal ball? No, we don't. And I'm not aware that we guessed what was going to happen in the future. Uranium was necessary. Nuclear energy is necessary, so uranium is necessary. Inflation, well, you never know when it's coming, but it always comes. But we are the anti-crystal ball. The future is not predictable, we believe, because there are many elements involved, and those elements interact with each other. So you should be able to know what those elements are and how they're going to relate to each other. And that's impossible. And since it's impossible, we want to protect ourselves against that uncertainty. How do you protect against that uncertainty? Buying cheap. And that's the essential thing. Having companies at a good price, at the best price, is the best protection you can have. Because whatever environment comes along that you cannot predict, you will be protected by these low prices. Question about Russia and Ukraine. There are several questions. I'm going to summarize in one. Can the Russia-Ukrainian conflict and the response of countries distort the prices of commodities temporarily, or will it have consequences in the mid to long term? Temporarily, yes, certainly. In the mid to long term, less so. What is the guiding thread here? For 25 years, we have been investing in all sorts of environments, and we know how to navigate in this one. Fernando, would you like to add anything to that? You explained it very well in the presentation, what we've been doing for the past 20-some years. It's not a full list. Has there been anything else? Well, September 11th, many more things. Brexit. We talked about the crisis in Europe, the euro crisis. Well, we went through many storms, many events, a long list of events. Maybe we have a slide. No, I don't think so. Slide 25. Did we show it? If we read that, I'm going to read it. I hope that you can see it. Basically, it says that in the 20th century, the U.S. has gone through 2 world wars, other traumatic and expensive events, military conflict, a depression, a dozen or so recessions, financial panic, flu epidemic, oil shocks, a president who was disgraced, and Dow Jones went from 66 to 11,500. You think it's impossible for an investor to have lost money during this period with these extraordinary profits, but some investors did lose. And those who did buying stocks only when they felt comfort in doing so, and then proceeded to sell when the headlines made them queasy. Today, this is in 2008. Today, people who hold cash equivalents feel comfortable. But of course, they shouldn't feel comfortable because they have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Indeed, the policies that government will follow in its efforts to alleviate the current crisis will probably prove inflationary and therefore accelerate declines in the real value of cash accounts. That is why, well, I thought it was interesting to show this because it reminded me of the crisis in Ukraine. Either you do it soon because you see things that people don't see, or then it's too late. When you leave when the siren is on, then it's already too late. David, this investor says, what probability do you think there's of a global stagflation? And your funds with high weight in commodities, do you think commodity companies will continue to do things better? Can you repeat it, please? Because it's 3 questions in one, right? What is the probability of stagflation, global stagflation scenario? We're not macroeconomic managers, but in view of the positioning of the funds with a high weight in commodities, don't you think that in this type of scenario, it will generate commodities companies doing better? Well, once again, it's very difficult for us to simplify. Stagflation is what happens when there's inflation and lack of growth at the same time. He talks about global stagflation. Yes. In my head, automatically, global. I don't see if I see the same growth in the U.S. as in Indonesia. I don't see it. Maybe you see it, Fernando. I don't. And then growth. Inflation and then growth. Growth is a function of the number of inhabitants and productivity per capita. Birth rates are different in the world, in different parts of the world. Productivity is a function of how many things those inhabitants can do, how many things they can do, how many more things they can do, which is a function of capital, which is a function of the legal certainty. So all these elements of growth go into the equation. So global stagflation, you're putting in 25 variables there. I don't know if population grows the same way in the U.S. as in Africa. Productivity grows differently in different parts of the world. Policies that attract capital, some of them are better, others worse. So global stagflation is all these other things that I just mentioned. So I think it is more complex And we have an opinion. Some countries we think will do better than others. We're not too optimistic with the West. Why? Because we've eaten up future consumption, which is the debt. But we do see the world reasonably well because there is a middle class that is making an effort to own a car, a fridge. Increasingly more people are having $5,000 per capita. So this is simplifying, and this is very serious, and we don't need to simplify. We don't have to simplify in investments. You just need to have sound companies at a good price in your portfolio and not think about global stagflation. It's much difficult to answer this. It's already difficult to know if there's going to be stagflation in the US or in Spain. Well, and Bangladesh and Indonesia are important because they contribute to growth, but how can we know if there's going to be stagflation there too or not? Imagine that we think that is going to happen, and we're not managers of macro events, so we don't do it. But even so, we're not made to keep investments in copper, and the copper is at $11,000 because we think there's going to be a global stagflation. If price value does not give us the right equation, we sell. You got ahead of the next question, how to protect the portfolio and what to do in this type of scenario. I can't add anything else to what we've already said. Yes, the best protection is buying cheap. We've been saying it all night long. And that's the way it is. It's the best risk control strategy because at the end, a cheap price includes many problems in the price. It factors them in. The best opportunities to invest has been in a situation of crisis, assets that were in a crisis because they were at very good prices. So low prices is a way to protect any portfolio. One last question about macro. We live through historical time. Are these things that are happening, is that a threat or an advantage for investment? Isn't this a good opportunity that we can find in our professional lives? Well, we're taking advantage of the growth of the East, the emergence of the middle class there. We would have to talk about the assets, the savings rate, the affordability ratio, but that's an opportunity, yes. The fact that the East is growing. Now, investing in companies in a hair salon in Philippines, we wouldn't do that. Técnicas Reunidas, Tula. Our second position after the last trading update has a debt of $2.1 billion, 2x its market cap. They announced that at $75 per barrel, they would make a 25 million of free cash flow. They would need the price of Brent at a certain price just to pay for the debt. Is this our second best idea? Good question. Good question. It says several things, really. It says that the company announces that it's going to generate 100 at 75. When you invest your money, it requires a bit more. It's more than what the company has announced only, because I would ask this client to look at the P&L, the balance sheet, compared to other years' balance sheets and financial statements, and he will find something that he will probably like. It isn't easy, but if he asks the question that way, it's not impossible. And we don't see 100 million in recurrent profit. We see something quite different. And what we see, we like. We like quite a lot. That doesn't mean that there's no risk involved. There are aspects that can turn against it. But 100 million profit, we don't look at that, and we don't look at 20 years to pay the debt. That's not how we see it. If we can talk with more details to customers about this if there were no COVID restrictions. Yes, the year 2022 does not reflect at all the earnings power. There are multiple factors that explain why it doesn't do it. And there's a second question. In the introduction is the same thing. This company, it does not benefit from 75% of sales expected because their prices are hedged. May 2023 and 50% in May 2024. What is your theory and what do you think about this company? I don't know, Fernando, would you like to answer? Yes, the hedge they did that they were forced to do because of the refinancing when it was at $50 is one of the things that is having an impact on the profits. For 2024, it's marginal, and oil prices are at better levels, so the hedge is much more attractive. That's the important thing. The hedges that they had to do, that they were forced to do when oil prices were different, but they mature, and in 2024, they're different. And then there are many options in the company. There are 3 or 4 improvement vectors. Leave it there.
Estando el cobre, oro y plata en máximos.
So after that event, the behavior has been worse than in raw material because the volume production has been less. So why repeat with Tullow Oil? Why? What would you say? Well, it's true. Buenaventura has run into all manner of difficulties. We've been with Buenaventura for nearly 5 years now, and we're not making money yet. Well, these things happen in the best families. I think that there are good news. We don't think that we have made a mistake, but if you don't lose too much, well, long-term profitability will not be affected. Bonaventure, we're there. And sometimes you sow when you harvest in 2 months. That was Goldfields. Sometimes it takes 3 or 4 years. That was Cameco. And sometimes it takes even longer. So it'll be, 6 years, what have you. But what is important is, Bonaventure, we believe, is worth more. We said when we bought Bonaventure that only Cerro Verde was worth 20. They own 20%. 20% of 20 is 4, and that is 15, 16 per share. But Verde closed, and it's nearly there. Cerro Verde now has multiplied by 2 or 3. So we'll see whether it's a mistake. We know that there have been problems, and we know that eventually it'll be worth more. It's been 2 hours of questions now. I think we should proceed at a brisker pace. What will happen to coal? Is there potential value at this point in time, despite the revaluation? Well, the coal scenario right now, say, against all odds, we have produced more electricity than ever, and it's all coal-based. A lot is coal-based. Not that we were relying on this, but this is just to cast a little bit of light on the more pessimistic voices with regards midterm evolution of coal, which, well, we're doomsday. Coal was going to plummet what was said. Now, we for a while now have been saying that coal is not going to be what we're all going to be using in the future, but it's also not going to disappear overnight. It is a raw material which continues to have a long life ahead of us for the factors we've said. It's not green, but it is very social. Remember, there's a lot of people out there who don't have access to anything but, I think, 35% of the world's mix. And we've also seen that what's most interesting, we could talk about demand at length, but it's actually supply side that things are happening. And this is a sector which is really being strangled, really being strangled. It's not that there's no investment. It's the companies are not even able to raise debt. There's definitely nothing being listed. There's no investment by capital funds. Actually, it's forbidden. It's spelled out that it's forbidden. So supply side, it's being very difficult to satisfy demand. And this is what we're seeing right now. Prices that are really unheard of in global terms. Thermal and metal. Never had the prices been what the prices are now. So what's important is there's very many mining companies in the world, and we have only invested in a handful of specific ones, which we really like and which, well, as far as we're concerned, are the best. And all of them have a huge potential at coal prices, which are far less than current prices. So we're not thinking about those prices. The investments are very attractive. Companies are going to generate tremendous amounts of cash, of course. These are very solid companies with fantastic management teams, very solid bottom lines, excellent assets, and that conservative coal prices are, have a huge potential. I'm not going to say what the objective price, but it would be 33 million shares. They're at 30 now, so that's $1 billion. The company earns 300. That's 30% yearly profitability. The bonus was 2%, so that's not bad. 30 to 2. Okay. There are very many questions and very little time. Técnicas Reunidas. Do you think that in terms of margins and contracts, is it always lagging behind when we think about oil, gas producers? And now, Javier, do we think that this was a mistaken investment? Is it lagging? Yes. The entire services sector is at minus 85, minus 80, Petrofac, Técnicas Reunidas. Others have died along the way. And we do not believe that this is a mistake. We deeply admire the Técnicas Reunidas culture. We believe that Juan Guaidó has protected the shareholder exceptionally so, avoiding a capital increase. These are very difficult times. Now imagine their business at this point. They have people in camps. You have COVID. You have to pay your employees. Fortunately, there was help from the state. And in terms of, Técnicas Reunidas, it was like 5 billion. They're going to be making between 150 and 200 EBIT. It's 54 million shares. They're at 8. It's worth 400 million. So the price is just ridiculous. So I think that, yes, it's a mistake. And I think that they're lagging behind as everybody else is. And yes, I think they will recover. And now, thank you for your hard work. In the international portfolio, for 3 years, we've been investing in tanks. And although they paid 15% dividends, the price has not grown that much as raw material. And in 21, they paid very few dividends. So this, despite the fact that the price of derivatives and oil is growing. So my question is, why are tankers in the portfolio? Can we expect some kind of a rebound? What is the logic? So could you explain why in a nutshell? Well, yes, they've been growing for a week and profits are better. And that is additional to that 25-30% plus the dividends in 20, plus the dividends that you mentioned in 2020. Well, this is reasonable profitability. And there's something else. These are very cyclical businesses. And as we've said, sometimes volatility is our ally. These companies, when they drop a little bit, it's true that we have a stable position and 3 years forward looking. When they drop a little bit, we buy a handful more. And then when they bounce back, if it's less than 9, we bought more, even though we already had some. And then when it recovers at 10 something, 11, we sell another handful. So there's that additional contribution, which is not that self-evident and which is there in the portfolio. Now, the reasons and the thesis, well, the same as before, because they're cheap from the point of view of the price to value. These are very cyclical. We normalize mid-cycle, very solid, and we see the potential. There's clear potential. What is really important here, as in general, is our analysis of the supply. We have been very thorough in our analysis. We have been very granular, and we are absolutely convinced that the upcoming 3 or 4 years are going to be interesting. Demand-wise, well, there's not much of a doubt, is there? And that's important. In the short term, why has there been no reaction similar to that of other crude-related sectors? Well, because it's not that easy at the end of the day. But let me just explain that tankers respond to production of crude, not to demand. They respond to production. And what we've seen in the past year, for instance, is that we have consumed inventories to the tune of 2 million barrels a day for an entire year. And that, has been shipped over the sea. But in the midterm, production and demand must converge. And crude inventories now are less at a lesser rate. They'll have to recover. Tankers will have to transport more crude than the crude that is demanded and supplied. Demand evolves. It's important to understand what the supply is, and you need to ask the right questions and do the right analysis. And these companies are cheap, so they're in our portfolio because they're going to be profitable. Another question, this has to do with crude again. Despite the fact that the price of the barrel is as it hasn't been since 2014, this is not being reflected at this point in time. So why would you say this has happened? Do you think that things will change in the midterm? And another investor says is, why is it taking so long for investment to pour back into this sector? Let me answer by saying that, again, this is a very heterogeneous sector. We have to go company by company. In some companies, the first we bought have multiplied by 3. And in the case of others, well, I have to say that they haven't been profitable quite yet. So we've got to go company by company. Each one has its specificities. Some will be harder hit by the price of oil. Producers, for instance, although not everyone has responded the same. So we're comparing this company with the one we described before, Tullow. And then there's other sectors, a couple of companies that benefit or are indirectly affected. But at the end of the day, we don't invest when we believe that for a specific segment is right. No, we think about the price. So we're investing in services for the oil industry. I said before, for instance, when the price was right, we didn't know whether that was going to happen before or after. And had we not invested, we would have lost 70% profitability in Schlumberger, say, or in Max Drilling. Others, as yet, have not been profitable. But we are not looking at the time. We are looking at the price. And when is the market going to discount or anticipate? Well, the answer to that is that this is very complicated. This is a part of the analysis that we simply leave on the side because it just makes everything very confusing. So why is it taking so long for investments? Well, I think that at the end of the day, it's investments reacting to prices. But now we begin to see a slight hike. For a couple of months, we've seen major changes, and companies, oil companies, the more important ones, Exxon, Shell, etc., have announced that they will be hiking their investment budgets for next year. Let's please see slide 34, which is providing information. You see that red line? This is what is produced, annual production, and the blue lines is discoveries. So investments will have to pour back into this sector. Thank you. Okay, more about oil. What about exports of crude and Iran? What's going to happen to the embargo? Our opinion. What do we think about that possible lifting of the embargo? Well, there would definitely be an impact, yes. Ha ha ha. I suspect my answer is going to be surprising, but practically not important at all from the point of view of the value of the companies in question, which is not to say that maybe it will have an impact on the spot price rather of oil. But in any case, we need to remember that right now what's on the table is whether the embargo is lifted before or after. A couple of months before, a couple of months after. We're talking about quarters here. We're talking about 1.5% of the global market. So yes, there will be a short-term impact, but at the end of the day, what really counts, we're talking about investments, we're talking about the value of companies that are affected by the price of crude. It's the long-term fundamentals, and we've already mentioned what they are, and we could summarize very solid demand and the lack of investment that would be described as endemic. That would be very important. And then the short-term impact, this is what we've said often. It's very difficult to forecast. It's very difficult to know what has been anticipated. Lifting the embargo, actually, I believe, is something that we all expected ever since President Biden was sworn into office. And actually, for the past 2 months, it seems to be imminent, but that has not been an obstacle to the price of crude at the end of last year being in excess of $90 per barrel. So what is the market anticipating, really? And when the embargo actually happens, or the lifting rather, there will be other factors to take into account. What is OPEC going to do with those new barrels? What is the rate of recovery of airline traffic, which is still suffering the final effects of COVID, which is, very important. All of this is important, all of it, but we are not particularly hard hit above and beyond, well, yes, think about the profits, but no, we don't think about the value. This morning I was talking to an oil trader, actually by happenstance, because I don't talk to him frequently. I was talking about something else. I don't know what the worth is, but he told me that he said that apart from Omicron in China, which is a lot, but if you didn't take that into account, the return to normal at a peak point, such as the driving session that in the summer, if it weren't for Iran, you're at -3 maybe, -3 barrels. So Iran would not even suffice to avoid very high prices. Thinking about, Iran and Venezuela, that's 1.3 and 200,000 from Venezuela. So you need to destroy demand because of high prices, even in the short term. I'm not sure what the numbers are because, as Fernando said, it doesn't really matter for the long haul. This is somebody who only does oil. So we're talking about the summer drive because the gallon in the States is at 4.5. Yes, so they're expecting that destruction. Okay, another question about reserves. How many years of reserves does the onshore oil in the States have? And at today's production, would it be good for 10 years? My answer would be years of reserves. I think that we should give a little bit of background here. Shale oil is non-conventional production. Shale oil. It's specific techniques. It's new. It happens in places that before were not commercial. So this is a phenomenon that has truly hit the global market in the past few years. There's no doubt about that. And please think that in 2009 to 2019, shale oil added to the market practically 9 million barrels per day. So in 10 years, we saw a new Saudi Arabia. So this is a phenomenon which encouraged partially there were other factors, of course, which have to do with other things, but it definitely had people thinking. People thought it was a source of growth at the prices, at moderate crude prices. We have studied this in great depth over the past few years, and the conclusion we've reached is that these spectacular growth levels were just not sustainable. And in fact, as of 2 years back, beginning before COVID, American shale has lived very turbulent times, and I think it's never going to be the same again. Those growth levels, very, very difficult for that to happen again. Now, to answer your question, again, this is we see over 10 years reserves, but what's important here, shale-wise, is that different to conventional production, this is the kind of production that calls for huge amounts, constant amounts of investment. Yes, you crack the rock, and yes, you produce the oil, but it dries up, and 2 years after beginning production, it's 80%. It's producing 80% less than it was initially. So I think that this is going to become the marginal barrel, if you will. When the prices of crude oil drop, there will be no more investment, and this will decline immediately. It will fall immediately, moderating those drops. But when the prices of crude are very robust, we will see that they may contribute more barrels relatively quickly. But I think that this is not going to be a decisively negative factor for that market. It's similar, but not the same. And it's going to be production, yes. We might be comparing in a positive way to shale because there are doubts as to the productivity of fields that as yet have not been exploited. And apparently the best fields have already been run dry. And what we're seeing is that despite very robust crude prices, it's barely not growing. In the Permian, yes, but we see that other fields, Ligon Ford, PAC, DJF, and so on, are either flat or shrinking. So we're not seeing those growth levels. Okay, and final question: are we not focusing now on sectors that provide services to oil companies, that capex, which is necessary, that you were talking about, and perhaps grow our share in these companies, our stakes, so offshore, say, oil? Thank you for your time. Thank you for your work. Thank you for everything. Very similar, I think, to a question that was posed before. Yes, in fact, we have invested in this service industry and offshore, which is a part of, and in some of them, because we wanted to be very specific price-wise, comparing with the value, we've already achieved that profitability, and we're looking forward to more profitability. Schlumberger, TGS, and offshore, TGS, and others, Bordelling, and others. So yeah, we've definitely got our hand in that sector, and at the right prices, I would say. Yes, there's a number of offshore dealers. For Sergio now, what are you doing with regards ESG policies? I think you need to explain what ESG is. How does it affect risk? Yes, these are the rules in place. ESG, environmental, social, and corporate governance. Last year, if you want to read it, our report on sustainability, and this report provides specifics, and according to those indicators, it's improving, but it generates uncertainty. There's a lot of dispersion in data suppliers, which does not happen, such as credit rating for companies. There's homogeneity, but in these cases, there is dispersion. And within those sustainability reports, we do include the integration policy of the risk in our risk model. So it's fundamental analysis, and we take into account any indicator that will affect the value of the company in the long term, including, of course, any environmental, social, and especially relating to corporate governance. Those are the more important indicators for us to manage risk because they may affect the value of the company. So we also talk about that risk policy, and we talk about our initiatives to improve social aspects in the company and corporate governance. So variable remunerations policy, at least 25% of employees must be invested in Azvalor funds, and in the case of partners, 50% of the variable will be invested in the fund. So that report is available, and you will see in it the specifics regarding the E, the S, and the G. Thank you. Now we jump to gold. José gold has been sky high, and it has rocketed further in the past quarter. But many gold mining companies are listed at a much lesser number than after 2008. Do you think this is because of Bitcoin, or do you think that eventually these mining companies will return to what they were worth? Well, let me see. I think that mining companies now are making a lot of money, more than ever before. I think it's just a matter of time. Okay, very quickly. Do we believe that we are in the face of a new real estate bubble? Well, we've survived one. The yield of a lease was 1%. Now, if you have a fixed rate mortgage, you're going to pay for that. So yes, high, because there has been activity for sure, but I'm not seeing the kind of a bubble that we saw back in as of 2004 or 2005 in Spain. I don't know. Maybe a bubble could, in fact, result from a fixed rate. If you get a loan at 2% and you're going to have 3 from the lease, well, that could result in a bubble. But I think that these fixed rates are going to be increasingly difficult to achieve. So companies have dropped a lot, as we saw. Some of the companies were tech. Could that be an issue in terms of rotation? Well, it could be if we tried. And let's understand, how much is a company going to make in the upcoming 5, 6, 7 years? I think that in some sectors it makes sense, but in other sectors, I think you'd need to be a little bit of a specialist. That would be case by case. I don't know, Fernando, would you want to add anything? No, perfect. Javier, for you, what would you say? Well, I would say that a goodly portion of my day is ensuring that we monitor our managers, and perhaps also when we talk about the process, the methodology, the analysis, and building the portfolio, but also personally understanding what motivates them, what has them working so many hours, how can they be so passionate? They've been managing for decades, and what keeps them ticking? That objective, those different variables, we want to ensure that they are still there. We talk with them recurrently. We analyze their portfolio moves and so on. We're very much on top of them. We talk with them formally, quote unquote, on a quarterly basis, and informally, well, pretty well every week. In some cases, I have their cell phone, and I can send a WhatsApp or text them or call them. And the second part is continuing to look for managers. The number of investment funds in the world is 330,000. 330,000. It's an ocean. It's an ocean to choose from. And what we do is say no to many. I mean, we have literally studied hundreds of managers over the years, and we work with 4, basically. So Over 90% of the times, we say no for whatever reason. We talked about some of these reasons before. It's true that the type of manager we're looking for is very special. It's boutique, it has to be small, a specialist, and this makes it, more difficult. It's a smaller universe. These are necessary criteria, but not sufficient because they have to know how to invest well, which is very complicated. And this has you going well beyond those limits, different, more technical points of views, understanding how they're doing things and why they're doing them and what happens over time. This, looking everywhere in all corners of the world and trying to bring to our company those whom we're looking for.
A question on mutual funds. I'm thinking about transferring my pension plan to Azvalor. I see no better choice for these savings. Is it late for me to transfer it? Is it late to transfer it, or do you think that there's still a long way to go in this portfolio? Yes, 85%, as Fernando showed us. In other words, there's still potential. Yes, there is. In the past 2 days, it has fallen a bit, though. Have you thought of organizing a department to advise investors? 2 questions about advice that always comes up when we talk to investors. What is a question exactly? 2 or 3 questions. Are you thinking of setting up an advice department to advise investors? To advise an investor, we need to assign him the right risk profile. We need to obtain suitability information. We don't do that. We explain very well what is the makeup of our portfolio and what profile the investor needs to have. If it's a 5 to 7 year investment and withstand volatility, and we explain to them what we do, but we don't advise. We can only advise professional investors or eligible counterparties. To investors, we just explain what we do and make sure that they have the right profile for our products. That doesn't mean that he can't get advice from a third party. And that does happen often. Let's start the final part of the questions with more personal matters or questions. After withstanding years suffering without the market recognizing the value of companies, don't you feel sorry when you get rid of them when they have a reasonable or fair value? This is for Diego. Why don't you answer, Fernando? Well, I'll do it. If we feel sorry for selling the companies when the value has increased or when it has reached fair value, some want us to sell as soon as possible. Others don't want us to sell at all. But they're both right, really. There's the right intuition behind that. When you make a lot of money, you sell. When you win at the casino, keep the profits and don't bet anymore. And yes, that's right. But also let the winners keep on running. That's also true. But every company is different and has its value. So yes, the sector tells you what is happening, but it doesn't determine anything. Technology has fallen 50% in many companies, but Apple has hardly fallen in value. Or in Spain, 2 companies that produce rice. One of them is a marvelous company, and the other rice company went broke. So the class doesn't really tell you much. It's not a matter of going in or getting out. When you go out to have dinner with people, they say, are you in or out of this or that company? And I think that is more serious than going in or getting out. You need to calculate many things. The easy questions of the exam, you can answer those. And when there's no more upside, you need to sell. Otherwise, you are incurring in a huge risk. Feel sorry? No, I don't feel sorry for selling these shares. I feel sorry for many other things. Fernando, what do you think when in just a few days many exposures reach their potential? And basically because of unexpected events, things can change. Do you increase the security margin, maintaining the position, or do you sell to look for new opportunities? I understand that this is a difficult choice to make. It's a difficult decision. It's a process that it's part of our DNA. Value, price on the one hand, and alternatives on the other hand. A week ago, we sold Arch and we bought Logista. We had both. One of them went up from 100 to 160, and the other one fell. Just to answer the first part of the question, but we don't recalculate the potential of Consol with thermal coal prices at whatever. From the outside, you might think it's so difficult to sell when it's going up. It's not that. It's a process, sometimes even boring when you talk about it, very exciting when you live it. For us, it's really exciting selling shares that have multiplied their value by 3 to buy shares whose value has fallen by 50%. In the past, you recommended managers that turned out to be very good, like True Value and others. They started their career as investors. Thank you so much. It was a very good recommendation. Could you recommend a manager that is starting now, not very well known, but accessible for a national investor? Yes, we recommended it because we believed in them. They're still excellent managers. But one that has just started, I have a manager that has been there for a long time, but his fund is small, but I think he's going to do very well in the short term. He invests well, and his time has come, I think. It's the Avante Pangea Fund. They have interesting things. It's quite mature. It was negative with technology, but positive in value, and that is the one I can think of. Other things we follow, we do mentoring with young ones, but to recommend, that's the one I could say. Perhaps in a year, I'm thinking about another one that perhaps next year I could mention that name. We'll see. Good recommendation. The 3 last questions, personal questions. Where do you see yourselves and where in 15 years' time? I couldn't say, but making investment decisions with these gentlemen by my side. Perhaps in 15 years, I'm 62. Well, with a little bit more time, perhaps to contribute to some causes, perhaps that I would like to help in, and that I can't right now. I see myself in Spain. I would like to see myself in Spain with my same wife that I've been married to for 22 years, with my same partners, and surrounded by my friends whom I dearly love. And I hope working with the same excitement and such exceptional colleagues. Perhaps a bit wiser, a better Christian, and to end with humor, and with a good golf swing that will allow me to beat any of my kids, even the 10-year-old. what do your wives and families think about your total dedication to this activity? This is very demanding, and it must not be easy for them. Can I start? Please. I think they understand it. I didn't think this before, or I wasn't so convinced, but I think this is vocational, a vocational profession, just like many others. And it's very demanding, yes, because of that passion that Javier mentioned that we have for the world of investment. If you like it a lot, like we do, I think they understand it very well. But it is demanding for them, yes, and I'm very grateful for their understanding and make it easy for us. And in terms of vocation, now I can distinguish a vocational investor from someone who wants to be an investor but who doesn't have that vocation. I think it was Graham or Buffett who said having an eye for value. That prices, call your attention. And you think, why has this price gone up? Why has it fallen? And you're constantly calculating. You have to have that eye for value. You're born with it. And I think that is what explains our vocation, which is perhaps not as beautiful as the vocation for medicine, but there is that element there. He's asked about his wife, and he ends up talking about an eye for value. In the past, they weren't that happy, but now they understand it, our wives. There's good and bad things to everything, but Carmen, I think, is very pleased, but a bit tired, like when you were in all funds. Maria has, been with me for 22 years, and well, they get used to it. But it is not easy for them. All the time we're in a conference call, looking at the iPad. Just a second, wait a minute, I have a call. It's not easy for them. Perhaps marriage is also a vocation. And lastly, very interesting, this question. I think it's one of the best questions we've been sent. What keeps you sleepless at night? Do you want to start? Well, many things worry me. Apart from not getting our investments wrong, but we've been at it for 20 years and we have a process for that, and that, that doesn't keep me sleepless at night. But perhaps some things that are harmful or things that hurt. Economic policies that affect everyone's prosperity. When you see that protectionist measures are adopted against international trade or confiscatory fiscal policies, that sort of thing. Because it goes against everyone's prosperity. And in my opinion, who suffer the most from this are people who have less. But I don't know, maybe I can think of something else whilst you answer. What keeps me sleepless? Well, like everyone else, from 40 to 55, which is the age where people get a heart attack. I'm a husband. I have 4 children. We have 30 employees. We have 60 companies in our portfolio. There's a fire every day. Every day something happens, and every day there's a reason not to sleep at night. But I'm also aware that you cannot control everything, that we need to control our lives, and we need to trust, too. I trust in God. So that trust, I cannot deny that praying gives me a great deal of peace. So I sleep very well at night. Not always, but the more I pray, the better I sleep. That's a rule that is also always true. I have a very good friend that I see almost every week. Very intelligent, very realistic person. He says 2/3 of his friends need to take something to live, to continue with life. Alcohol, the pills, whatever. So perhaps we have to turn into children again. Otherwise, it's very difficult to withstand everything. But if you're a child and you thinks, well, it's easier to sleep. Otherwise, life is too aggressive. Maybe at 70, your children no longer pay attention to you, your parents are dead, you don't work that much. Life is easier. We are in the most difficult part of life. And with the great team we have and the clients we have, you have to thank God every single minute. And so, but you can't control everything. But if you have your invisible friend, like my son told me, you have an invisible friend. So that's how I see it. This question is also for you and for Sergio. I sleep very well. The tax authorities paying taxes. No, I'm kidding. I feel very well accompanied professionally and personally, and I think I'm very fortunate. And there aren't many things that don't let me sleep at night. Injustices, but nothing specific. Perhaps Sergio doesn't sleep so that everyone else can sleep better. No, I sleep reasonably well. My children's health is the one thing that can concern me the most. And next week, I'll probably lose my sleep with a Champions final that we are going to lose again probably. Well, if there are no more questions, we can close this part, the Q&A, and thank you everyone for following us until almost 9:20. And we'll see you in the next conference. And I hope that we'll be seeing you throughout this year. Thank you very much.
Muy bien.